Hi, my name is Carmen Chu, San Francisco's elected assessor. Buying your first home is a big deal. For many of us, it's the single largest asset that we'll own. That's why it's really important to plan ahead for property taxes so that there are no surprises. A typical question new homeowners ask is, what is a supplemental tax? To understand supplemental tax, we need to start with Proposition 13. Under California's Prop 13 law, the value we use to calculate your property tax is limited to a 2% growth per year. But when ownership changes, Prop 13 requires that we set a property's assessed value to market value. The difference in value between the previous owner's value and the new value is the supplemental assessment. How does the supplemental assessment translate to the tax you need to pay? Supplemental tax is calculated by applying the tax rate to the value and then prorating it for the amount of time that you owned it in that tax year. In general, the tax rate is roughly 1%. Let's walk through an example together. Here, Dan is the original owner of a home with a Prop 13 protected value of $400,000. With a tax rate of 1%, he pays $4,000 in property taxes. Dan sells his home to Jenny at a market value of $700,000. In this case, Jenny's new home will be reassessed to $700,000, and Jenny is responsible for paying property taxes at that level from the time she first owns it. Many times, people might have already paid their property taxes in full by the time they sell their home. In that case, Dan has paid $4,000 in taxes already for the full year. Jenny would likely pay back Dan through escrow for her share of the $4,000 depending on the proportion of the tax year she owns the home. However, she's also responsible for paying taxes at the higher market value from when she begins to own the home. How does that work? Let's say Jenny owns the property for 9 months of the first tax year, which is approximately 75% of the year. During the escrow process, she'd pay Dan back 75% of the $4,000 he already paid, which is $3,000. On top of that, she would owe taxes at the higher rate for the proportion of the year she owned the house. In this case, she owes the amount not already billed through Dan, or $700,000 minus $400,000 multiplied by a tax rate of 1% and multiplied again by 75% to reflect the time she owned the home in that tax year. Here, Jenny's supplemental tax is roughly $2,250. Going forward, Jenny will be billed at her new reset Prop 13 value. Are you still with us? If this isn't complicated enough, some new owners might receive 2 supplemental tax bills, and this has to do with the date that you transfer property. But before we get to that, you first need to understand 2 concepts. First, what is a fiscal year? In California, local government runs on a fiscal year. Unlike the calendar year, where the year begins on January 1st, a fiscal year begins in the middle of the year on July 1st. Property tax follows the fiscal year cycle. Second, state law requires property be valued as of January 1st every year, in other words, New Year's Day. The value as of January 1st is used to calculate property taxes for the upcoming fiscal year. This means property value as of January 1st, 2018 will be used for fiscal year 18-19, covering July 2018 through June 2019. Similarly, the value on January 1st of 2019 will be used for the fiscal year covering July 2019 through June 2020. Now back to whether you should expect to receive 1 or 2 supplemental tax bills. The rule of thumb is that if the property transfer happens in the first half of the fiscal year, in other words, between July and December, then you should expect only 1 supplemental tax bill. If the transfer happens in the second half of the fiscal year, or between January and June, you should expect 2 supplemental tax bills. Here's the reason why. Using Dan and Jenny's example again, Dan's $400,000 value as of January 1st is used to set the tax bill for the following fiscal year, beginning July through June of the next year. Jenny buys the property from Dan in October. The taxable value is reset to $700,000 as of October. But the bill issued still reflects Dan's lower value. In this case, Jenny would expect to receive one supplemental or catch-up bill to capture the difference between her assessed value and Dan's from October through June. Because as of the next January 1st, we already know of the sale, we would have used Jenny's new value to set the following year's property taxes, and no other supplemental bill should be received. However, if Dan sells the property to Jenny in March instead, Jenny should expect 2 supplemental bills. Like before, Jenny would receive one supplemental bill to cover the time in which she owned the home in the current tax year from March to June. But because as of the next January, used to set the tax base for the following tax year, Dan still owned the home, the following year's entire bill still reflects a value not updated for Jenny. In this instance, Jenny receives a second supplemental for the following year covering July through June. After the supplemental tax bills, new owners should receive only one regular tax bill per year going forward. Remember, our office values the properties, but billing and collections are handled by another organization called the Treasurer and Tax Collector's Office. If you'd like to learn more, please visit our website at sfassessor.org. Thank you for watching.